Good morning again. Jesse McRae, Managing Partner and COO of the Playbook Investors Network. Just in case you missed the opening of our initial broadcast, I want to welcome you back. As they say, things happen, but we're going to make the most of the remaining 42 minutes that we have and again deliver an action-packed time talking about the importance of the income statement, statement of cash flows, and balance sheet in the capital raising process. As we dubbed earlier, this is going to be the coffee and conversation edition of Playbook, or what we say, PEN Global News, by way of Playbook Investors Network, www.playbookinvestors with an S, and I won't sing it today, network.com. You can get PEN Global News by way of YouTube and Facebook Live. But most importantly, let's enjoy this time that we have today to talk through the importance again of the income statement, statement of cash flows, and balance sheet in the capital raising process. That said, part 2 of the CFO series will begin again with Rick Toussaint. Rick, welcome back.
Thanks, Jesse.
Brief 90 seconds, but we're back. Let's talk more importantly again about, you can just recap for our viewers, revenue, cost of goods,
yes,
and selling goods and expenses, also known as SG&A.
That's correct. So we're going to recap at
top line revenue.
Top line revenue. So top line revenue is our price for our good or service per unit, per project. And if we price that at a certain dollar amount, we then move down the income statement to the cost of goods sold. And that's going to be a combination of materials, that'll be a combination of labor and other direct expenses that are material or necessary to generate that top line revenue. We need that number to be positive. So we need a positive gross profit. It is from there, that gross profit number, we begin to pay the administrative cost of running our business. That's going to range from office expense, administrative personnel, interest payments on debt if we've borrowed capital, and taxes. From there, hopefully in a perfect world, then we're going to have a positive net profit. And this becomes one of the key components of how a business is gauged. You use that to determine the effectiveness of management, how successful they are, and it is one of the components to raise capital. You're going to be judged on this.
You're going to be judged on it, and
right.
as our partner, Brett, I certainly want to send a shout out to Rodney Woods,
yes,
our CEO and founder, and Tracy Mack, McGrady, T Mack, and of course AD, Doc and Dame, and many of the folks that support us in terms of the leadership of the firm. We always talk about how do we take those next steps to adequately portray our ambitions. And the first part of this with the income statement, that's where it really starts.
Right.
As Rodney would say, we always have to kind of tease Rodney, short, sweet, to the point.
Yes.
How much money do we project to make?
That's right.
How much of it do we project to keep?
That's
how much
correct.
is going to go out on hard labor?
That's right.
And then what's remained, how do we share the spoils?
Exactly.
So if I'm hearing you, and our viewers are hearing you, when we look at the top line revenue and how important it is to, as accurately as we can, because these are still projections, if we say that we're going to make $1 million,
right,
and we're going to pay out, let's say, 15% of that in cost of goods. Now we've got $850,000,
right,
and we're carrying about $400,000 worth of office rent and salaries.
Sure.
Now we're down to about $350,000. There's $350,000 there that is for debt service.
Correct.
And then once we pay the debt service, we've got net income.
Right. In theory.
In theory.
We may have taxes.
We may have taxes.
So when it comes to planning and projections, I tell every business owner, it's not 3D. You have to be able to see in 4 dimensions. And it's planning. It's taxes. It's knowing how receptive the market is going to be for your product, how much money you have to spend in marketing to generate those sales projections. It's a very involved process, I've found, in my experience. And you have to take into account all threats or expenditures that would affect your revenue and ultimately your profit. So it's involved. It's very involved.
But here's where, again, I get to play Rodney.
Okay.
I'm going to play devil's advocate.
Okay.
Okay? I understand my marketplace.
Sure.
Mr. Toussaint. I understand it well. And I've had the same group of suppliers that have been supporting my business for years.
Good.
So I have my hands on the pulse of my cost of goods.
Okay.
You know, I'm never going to leave this building. I know that the air conditioning is suspect in the summer, but it's the rent that I know, and I'm going to pay it, so I'm going to stay here. And you mean to tell me that I still have to account for the tax advantages or disadvantages associated with my business to where now I can't just rob Peter to pay Paul, take a little money away off the top before I pay everybody else and pay myself a little bit out of EBITDA?
Sure.
Pay myself a little bit out of net income
Sure.
before I go and pay all these other debts to get a true reflection of my net income? You're saying that I got to be judicious all the way?
Yeah, throughout the process. I always liken it to you don't control everything. So essentially what happens, there could be changes in the market. There could be changes in legislation. If you're a manufacturer, well, what if there's a shortage of steel or around the globe, or there's ultimately a major demand, which in theory would increase your revenue.
Yeah.
But then if you don't have the ability or the capital to acquire the right people or natural resources, now you can't take advantage of those potential increases in revenue.
Sure.
So you have to have these projections. You have to have a plan. And I always say stay the course and make adjustments along the way. Budget versus actual results. And then you make course changes throughout the year.
So you're saying it's one thing to start out with a strategy, it's another thing to be tactical.
Exactly.
As it relates to how we navigate through the income statement.
Exactly.
Oh, that's awesome. That's awesome.
Yeah.
So again, Jesse McRae, COO and Managing Partner of Playbook Investors Network. You can find us at Playbook Investors with an S network.com. Also continue to follow Penn Global News by way of Facebook and YouTube. Here with part 2 of the CFO series with Rick Toussaint, the importance of the income statement, statement of cash flow, and balance sheet. You know, that was a really, really good run through of the income statement. And I will tell you, both as a peer
Sure.
and as an entrepreneur, we all have those conversations where we have to speak to the what ifs. Mm-hmm. And what you just brought up were some big what ifs.
Sure.
Especially with regard to legislation, which is, for most businesses, is going to be the framework within which they're governed.
That's correct.
As relates to what they can charge, what they can do, because they're soliciting the public for revenue. But now let's segue to the statement of cash flow.
Okay.
You know that one document that we all remember in accounting,
Mm-hmm.
that is filled with a few entries. But the one
Several.
But you know, the one that I always found interesting, was that entry that talks about cash flow activities by way of financing.
Right.
Because again, what we're talking about is when companies come to our portal by way of www.playbookinvestorsnetwork.com, and they go in, and as a new subscriber, they're coming to us to position themselves to get capital.
Sure.
They go through, they take their assessment, they're filling out the financial aspects of the information that's required in the assessment, because again, we're positioning them to go to the investing public. The income statement's fine. Mm-hmm. And normally in your executive summary, you're going to speak to that a little bit.
Sure.
But whoever speaks to the statement of cash flow, particularly
Very rare.
Cash flows from financing. And I know that we're getting a sneak peek into the balance sheet, but talk a little bit about the importance of highlighting that, especially when we're talking about raising capital.
Okay, so for me, and I found from the investment standpoint, a lot of investors they're gonna maybe hone in on sources of capital from financing, because though that number or that section of the cash flow statement, it illustrates how much capital it actually takes for you to sustain from period to period. So if we look at a 12-month operational period or operational run, you'll have components from the statement of cash flow, like maybe the owner makes an advance into the business. Well, that kind of points to the fact that the business had capital needs that maybe weren't anticipated. So now the owner may have had to come out of pocket, advance capital into the business to help the business sustain. You're also going to have another category or line item, sources from financing or debt. And these are going to be bank loans or the issuances of bonds. And these are debt instruments that also carry a interest payment. So when you look at that line item, it's great that you've been able to raise that capital, but then that capital comes at a cost, and that cost has to be met monthly or quarterly.
Sure.
And then finally, there are other items, but I want to keep the example simple.
Yep.
Cash flow, positive cash flow from issuance of stock. So many times corporations are going to have to issue stock to stay alive, to stay around from period to period, or stay viable. So an investor is going to look at that section of the cash flow statement, and again, all of these decisions are like you get graded on it from an investment to a manager of a business standpoint. So how you use the capital, the ratios of how you bring in debt to equity, this really matters because it all impacts your business, and you have to be able to be on top of that and understand the ramifications of these decisions.
And of course,
right.
we always, in keeping with the spirit of how we do the broadcast, we want to make sure that we appeal to all of our viewers.
Sure.
I think that conceptually, all of our viewers get what it is that you're saying.
Mm-hmm.
But let's make sure that we just take this down one more level and make it immeasurably simplistic. So, I've got my income statement that I'm saying this is the amount of revenue I expect to make.
Right.
These are the costs I think that are reasonable associated with my business.
Sure.
This is what I project to be left over for debt service,
mm-hmm.
and this is what we hope will be net income.
Right. Don't forget taxes.
Don't forget taxes.
Right.
I will almost say don't forget death.
Yeah. They go hand in hand. Trust me. Yeah.
So when we talk about flowing through or having continuity
mm-hmm.
of these documents, we talk about the statement of cash flow.
Oh, certainly.
What should I be able to tie, mm-hmm. if I can tie, as an entry on the statement of cash flow to the income statement?
So,
or connecting the dots.
Yeah, certainly, immediately. So the income statement flows into the cash flow in this way. Your net income or your net loss is the very first entry on the statement of cash flow.
Awesome. Good.
The very first entry on the statement of cash flow. So these documents are interlinked. Okay? So right off the rip, you know if you've lost money or if you've made money. Another item is going to be items such as assets. So you're going to have inventory or...
let's not skip too far into the balance sheet.
Okay,
You're still in my thunder. You're still in my thunder a little bit.
I'm going to let you drive.
You're still
You're
in my
Michael
thunder
Jackson,
a
I'm
little bit.
Tito. Okay.
And together we're going to go platinum.
We're going platinum together.
Believe that.
Right.
Jesse McRae, COO, Managing Partner of Playbook Investors Network. You can definitely find us at www.playbookinvestorsnetwork.com, and also Penn Global News by way of YouTube and Facebook every Thursday at 10 a.m. Central. We hope that it will continue to be a segment like this where it's as action-packed as we can get it and our infrastructure is solid, but I tell you what, it's been good and we hope that you're enjoying it thus far. Back again for part 2 of the CFO series, the importance of the income statement, statement of cash flow, and balance sheet with our CFO, Rick Toussaint. Rick, I something came to mind just a moment ago.
Sure.
You were talking about the last item on the income statement being the first item on the statement of cash flow. You know, that reminds me of an instance when I was growing up where, you got that auntie,
mm-hmm.
or you got Big Mom.
Oh yeah.
That's making pound cake.
That's correct.
Okay. Now I don't know about you. I don't know how they did it in the booth,
mm-hmm.
but in Pine Bluff,
mm-hmm.
that pound cake is getting stirred.
That's correct.
Now, the cake is going into the pan, it's going into the oven,
mm-hmm.
but there was always something left in the bowl.
Right.
Okay. Now, my finger was going in the bowl.
Yes.
And I always thought I was getting away with something.
Right.
I always thought I was getting away with something, but as a kid, I realized that every time I put my finger in the bowl, I left a footprint.
That's
or
correct.
a fingerprint.
That's correct.
That went from that bowl to the edge of the sink where I was propping myself up to get.
Right.
So the last thing I touched was the first thing they found to figure out who had their finger in the bowl.
Right.
So let's get back to the statement of cash flow and income statement. If I'm understanding you correctly, there's really not a lot of room to play with the continuity between the income statement and statement of cash flow, because whatever is the ending entry on the income statement
mm-hmm.
should be, by all accounts, the first entry on the statement of cash flow.
That's correct.
And if it is not, then we've got somebody that left a fingerprint
That's
on
correct.
the bowl.
That's correct.
Is that true?
So what that points to is that you may have inadequate staff or intellectual capital in your finance and accounting department.
Or a nephew that wasn't slick enough to wash his hands after he finished.
Right.
Okay,
Or you've hired a family member to do your books.
It's
probably the same thing. Yeah.
That's a great analogy. So we talk through the importance of the statement of cash flow, and we talk through how to adequately portray the interconnection between these two statements. What is the singular thing that must be highlighted to that investor as it relates to the kinship between these two? Is it simply just the continuity from an accounting standpoint, or is it more so talking through how we are truly being judicious and disciplined with managing the money when it comes in, managing the checks that go out, and to show that we actually did these things with this money as a result of this debt?
So rolling from the income statement to the cash flow statement, again, as we've stated, the profit or loss on the income statement is going to be our first line item on the cash flow statement. From my standpoint, when I look at a corporation to make an investment or advise, I look at the changes in the financing section, which we talked about. So most investors are going to see or look for what are your sources of financing. What have they been before I get involved as an investor? Okay. Now we'll go to the. There's another section on the cash flow statement section, sources and uses from investment. From investment. That's where we look at either the acquisition or the disposition of certain assets and other accounts. And one measure of success in operating a business is the utilization of hard assets. So it's managing inventory, it's managing real estate, it's managing, I can look on this cash flow statement and determine if you're using your money to buy vehicles, things of that nature. Just that's an extreme example, but you look for changes and you look for red flags in that section as well. Right.
And to that end, what are some of the red flags that would kind of reveal themselves? Because we always want to keep this simple.
Okay. 2
or 3 things that investors will look for, and more importantly, what our subscribers should be prepared to speak to.
All right. So if last year when I analyzed your business and you may have owned real estate, well then I can look in the cash flow statement and determine that, wait a minute, well, Jesse, you disposed of your real estate holdings. Well, why did you do that? Were you not making money on them? Did you dispose them out of your business and now they're personally your real estate holdings? Well, then there's a payment back to the business that's owed. So you look for changes such as that. That would be one potential, not necessarily a red flag, but it's a situation where you ask questions.
Sure, and
due diligence.
And due diligence. This is where I'll play Rodney.
Okay.
Because again, from a devil's advocate standpoint, you and I both know that there are growing businesses that have done a good job. They've honed in on their craft.
Sure.
But they've not always been attentive to the details of that business or managing the dynamics around that business, such as the disposition of an asset, which could represent cash flow.
Yeah, it actually could.
To the business,
right.
Which has its own set of tax implications.
Yeah, but it's positive.
But it's positive. Yeah. It's positive. So here's where we come back and we ask the question, now wait a minute, Rick. Again, I understand my business. And I had that land. That land was passed down from the family.
Right.
Okay.
Right.
So what do you mean, the fact that this land is gone now, that I have to reflect that in the books of the business? Why should I have to do that? That's family land.
Well, if you want my money, if you want my investment, if you want my involvement, I need to determine the effectiveness of your decision making, so I know who I'm doing business with, and if I can trust their management style.
There you go.
Or critical thinking.
Fantastic.
Right.
And that's where it really becomes critical, because we understand that when it comes to soliciting the public, whether it be to support your business or to invest in your business, which is a degree of support, that it is very important that if nothing else, the perception, which can be the reality, is that you're being ethical, you're being judicious, you're being disciplined. Jesse McRae, Managing Partner and COO of Playbook Investors Network. You can always find us at www.playbookinvestorsnetwork.com. Penn Global News here Thursday with Rick Toussaint for part 2 of the CFO Series, the importance of the income statement, statement of cash flow, and balance sheet. You know, Rick, that was impactful because I think that with most, well, I won't say most, but many,
sure,
of the going concerns that you and I have engaged in our past professional lives and that we continue to talk to now, fail to keep in mind the importance of not just managing their business, but the perception of their business.
Correct.
To their customers, to their suppliers, and in this context, to their investors. Now we're getting to the meat of the matter.
Yes.
Where all of the coins come to a singular accounting, as we say. Okay, and that is the balance sheet.
That is correct.
Now,
the big boy.
The big boy. The big boy. This is the harbinger of all the commerce.
Right. As
we say, this is where the currency is kept, the secrets are revealed, and the wealth is either created or lost.
Right.
So we talk about the income statement, the importance of the revenue, the flow through the cost of goods,
sure,
what's left after you sell your product or service, paying for the support of staff, which is certainly important, paying for the debts that supported the business. There's net income that's left to declare dividends.
Certainly.
There's an adequate accounting of that net income to the statement of cash flow. The statement of cash flow is a fair representation of the debt, if any, that was utilized to support the business. And now we're going to the balance sheet. Now, you and I both know from our accounting days, we know that balance sheet, in order for it to balance, the assets had to equal the liability and the owner equity.
Owner equity.
We know that.
Right.
You know that. Now, and this is just a subtle shout out to Rodney Woods, because I have to mess with Rodney, because Rodney's key theme is, look, man, let's keep this short and sweet and simple. Short, sweet, and simple. Describe an asset.
An asset is a holding of the company or the corporation that the company has fair title to, and it's tangible. So we can start simply with cash. If I open a corporation, I incorporate it, open a bank account, and I'll put $100 in that bank account. Well, that $100, it belongs to the corporation. That is now an asset of the corporation. Wow. For example, that's simple, but
very simple.
The key component of an asset of a corporation, the corporation has to have legal, fair title to that and custody of that asset.
Of that asset.
That's right.
Because custody, and that can get into an hour-long segment in and of itself.
Yeah, that's
and
true.
We'll talk a little bit about that, but we talked about cash. What about equivalents?
Cash and equivalents. So, okay. Hopefully, we're going to build a large corporation here. Well, we don't necessarily have to hold all of our liquid capital in cash.
Right.
There's short-term paper. There's also stock, mutual funds, that if you have a private corporation, you do have the luxury or the opportunity to invest in. So what is it, Jesse? The FDIC has a limit on cash insurance.
Absolutely, insurance on it.
So I think you're capped at
$250,000.
Thank you, sir. So if you have an excess of that, you may, in excess of $250,000, you may want to invest some of that cash into short-term, overnight repurchase agreements, treasury securities, or stocks and bonds to hopefully generate a better return. And
liquid instruments that are readily convertible.
Readily convertible,
yeah,
that's correct.
Yeah, that's why we call them equivalents.
Yeah, exactly. Yeah. So they're going to have a short-term maturity of 1 to 3 months.
Sure.
Yeah.
And I've even seen some books of some small companies that actually reflect investments. Now, there's real estate, which conventional wisdom says it's a longer term holding, because at times it may not be readily convertible to cash. In fact, it rarely is ever readily convertible into cash.
Unless you're in a hot market.
Unless you're in a hot market, like 07.
Right.
We won't bring that back.
Let's not go there.
We won't go there.
08, because 08 was painful.
It was very painful. But let's talk about, to your point, some of the equivalents for additional yield. And we're not going to get too much into the financing aspect, but these are other ways that the savvy, growing business can not only pad the balance sheet, but accrue on a compound daily basis additional liquidity for a rainy day.
Exactly.
And the importance of that as it relates to another little area of the balance sheet called retained earnings. But
That's
we'll just stick with the equivalents right now. So if you can expound on that a little bit, because maybe some of our entrepreneurs are just thinking, I got to keep it all in cash. My bank hasn't presented any kind of money market option to me. But there are some other ways that you can really beef up the asset side of the balance sheet before you start to get to the debt side.
Yeah, without a doubt. So we could look at T-bills, treasuries. So you can acquire or purchase treasury bills. I think in the Jesse helped me with this 3 months,
3 months, 6 months. You can go to 1 year.
Go to 1 year, and these instruments are going to provide you a better yield than a bank savings account, and they're readily convertible into cash.
Okay, with the state of this yield curve, I would say yes.
Yeah,
we are in a rising rate environment,
right.
so that
That's
could
right.
change. But generally speaking, you're right.
Right. So that's one opportunity for a corporation or an entrepreneur to obtain a higher return on their liquid capital. And I think in many cases it's actually a wise or a smart move.
Yeah.
Then we have money market securities that could consist of treasury bills or overnight repurchase agreements. Again, it's a decision of management that's going to provide their liquid cash or the corporation with an additional return on their capital.
That they don't necessarily need at that time to run the business.
You don't necessarily need it.
Right.
Very, very good point.
Yep.
So when you have excess capital, cash, or excess resources,
which we should be able to trace back to net income to some degree. Maybe.
To some degree, right, and retained earnings.
Yep.
It would be wise to seek higher yields. To surmise, look for higher yields. So T-bills, overnight repurchase agreements, or money market securities. So,
but as Rodney was saying, now let's stay in our lane. Let's not try to run a broker deal or an investment bank or a hedge fund out of net income for our business. But all humor aside, great point. Let's talk a little bit about, and the reason I want to preface it this way is because generally speaking, simplistically speaking, we've talked about revenue on the income statement from a commodity or product.
Sure.
As it is bought and sold.
Okay.
But I want to, as some of our partners will say, let's flip the script just a little bit. Let's go with something a little more agile. Let's talk about a patent.
Patent.
Okay. Because that's an asset.
Yeah, it is.
If it's yours, whether it's pending or not, you have custody of it.
Yeah.
If you legally own it.
It could be a very lucrative asset.
Very lucrative asset.
Right.
So we talk about a patent, and there's a reason why I'm going to come to this when we get to the debt side of the balance sheet, but that shows up a lot of time on the asset side of the ledger. And if it's been monetized, depending on how it's been monetized, if it's been used as collateral, it'll show up on the debt side of the balance sheet. I don't think it should, but I'm not a tax accountant, so that's outside of my wheelhouse. But speak to companies out there that may have a particular product from a manufacturing perspective that has a patent on it, and perhaps how that should be reflected on the asset side of the balance sheet as relates to how they will go out or could go out and solicit the investing public.
Okay, so a patent is going to be under the category typically of intangible assets. So other assets or intangible assets. And essentially your patent or your intellectual property is going to be a creation of a new process or new product or some form of technology that has monetary value now and into the future.
Sure.
And you can obtain third-party studies. Well, first, you have to legally tie this patent up, ensure that it's yours, that you or your company have custody.
Because we don't want to get into white papers and all of a sudden somebody takes your idea.
Takes your idea.
Yeah.
So you have to have the legal protection, which ultimately then is going to help drive the valuation of your patent. Now, as it relates to an investor or an investment standpoint, you would want to take this third-party study, allocate a value on your balance sheet to this patent, and then an investor can then, it provides a guide of the potential of your idea of where your business is going. And I think one of the lost opportunities of so many small and mid-sized corporations, because a lot of times we have to be creators to survive, we create ideas and mechanisms that are so valuable, We never patent these.
Never patent them. So to go back into the archives, and this is before you can.
It's lost opportunity.
It's lost opportunity. Yeah. Rodney and I talked about. In fact, when we were making the drive to Houston earlier in the year, we were talking about how on one of the shows, the do's and don'ts of finance, of how an idea goes from a napkin to an 8.5 by 11, to a whiteboard, to an executive summary, and then it just fades.
That's correct.
It fades to black. So to your point, great ideas that for whatever reason may not evolve, garner the enthusiasm and support, and money to develop and become something more tangible. So I want to make sure that we at least highlight the fact that if you have an idea, the whole point of that idea is to be monetized.
That's correct.
Plain and simple. So Jesse McRae, COO and Managing Partner of Playbook Investors Network. You can always find us in our portal at www.playbookinvestorsnetwork.com. Penn Global News every Thursday at 10 here for part 2 of the CFO Series. The importance of the income statement, statement of cash flow, and balance sheet with Mr. Rick Toussaint, our CFO. Rick, we've had a very, very good discussion about the income statement. A really substantive discussion about the statement of cash flow, and we've covered the asset because every business has got to have an asset. Cash, equivalent, furniture. Okay. Patent. But one of the things that you ever so shrewdly reminded me of is when we're managing our income through the income statement, we're always having to account for, even before taxes, debt. So now we're getting into the liability side of the balance sheet. Now, just like we have long-term and short-term assets. Okay. Patents. Real estate, receivables. We can get into the short-term and long-term debts.
That is correct.
Payables. Debt service.
Yes.
So talk a little bit about the 2 or 3 things that, as a CFO, as a consultant, that our suppliers, when they get ready to engage the investing public and it's time to look at that debt side of the balance sheet, the 2 or 3 things that really should be spoken to, and for the sake of continuity, the tie back to the interest entry on the income statement. Because again, these are projections as compared to historical performance.
So, keep speaking of liabilities, what I look for, and we may have to have a discussion on ratios.
Yes.
One day also.
Current ratios. Got that. Another show. Folgers for sure.
We're going to have community or Folgers.
No, it's going to be Folgers, brother. Okay. Go ahead.
That's right, Mike. Okay. Short-term liabilities and payables. These are going to have maturities or due dates less than 1 year. These are the day-to-day, month-to-month expenses.
Hard expenses.
You have to meet to keep your doors open.
But wait a minute. Rick, I've already written the checks for these out of the income statement. You mean tell me that I got to account for them again?
That's correct.
I mean, I got carbon copies of my checks.
Well,
I can see it online.
That's true.
Okay? But it's important to flow that back through in documentation to the balance sheet, is what you're saying.
So we're talking about accrual accounting now versus cash accounting. So accrual accounting, even though I may have paid my payables or my day-to-day, month-to-month expenditures last week, I have expenditures and obligations that are due within the next 12 months. They're going to be reflected in my accounts and accrued expenses, short-term. They're not going anywhere, and they have to be dealt with and addressed. You have to plan to meet your monthly obligations.
Planning. Now, to that end, again, we're going to keep this short and sweet and to the point. How many times have you and I, in a past life and even currently, in engaging, evolving businesses where we've got payables that we're paying every week.
But
we've got receivables that are now becoming aged. Now, back when you and I were doing T accounts back in the day, we referred to this affectionately as accounting synchronicity.
Yes.
In this case, we've got a business that is a viable business, is bringing in good cash, is writing good checks every week. The checks are clearing.
That's good.
Yet we've got somebody in accounting that is pulling his or her hair out because they've got this receivable that was supposed to have been paid the end of the second quarter. Here we are into the fourth quarter, still haven't been paid yet.
Correct.
How should, if that is the case, how should one of our subscribers be prepared to speak to that? Because if we're talking about being judicious in terms of the revenue on the income statement, we're talking about the continuity from the income statement to the statement of cash flows. We're talking about the fact that we've got some cash and equivalents on the asset side of the balance sheet. Then how do we speak to, or be prepared to speak to, any misalignment in our accounting on the debt side of the balance sheet?
Okay, so if I understand the question properly,
I've got current payables and aged receivables.
Here's what always happens in reality is what you just said. We may have a good customer, we may have had this customer for years and they pay. Well, one day they have a problem. They have a financial problem. It becomes your problem. Now they can't pay you every 20 days. They may pay you every 60 or 90 days. But your payables are due every 30 days. This is where financing, planning, and the type of planning, the type of financing comes into play.
And also some of those cash equivalents that we talked about.
Right. So it's a balancing act, because what happens is if you have cash and these cash equivalents, you actually want to hold on to that as long as
you can. Right.
So then now you have to determine how much debt or equity you're going to bring in to allow you to operate and sustain your business. What I tell, again, many small and mid-sized corporations, you need to plan to exist on not being paid by your customers for 90 days. You have to plan for the worst.
So a 90-day reign,
without
90 days.
90 days. Because if you're doing business with a Fortune 5 or a Fortune 1000, and you're small or a mid-sized vendor, they may like you. They may need you to count the spend, but they still run their business their way. And many times they're not going to jump through hoops for you.
Now, that would suggest that there's not, we won't call it malice, we'll call it gamesmanship from an accounting standpoint.
Sure.
Okay. So if we have our subscribers that are going to solicit the investing public and talk about the importance of this investor's capital and the debt that it represents, is it not logical to have to respond to the question of, well, how are you currently managing your cash flow and the debts associated with that? Because an aged receivable becomes a debt.
In a way.
In a way.
Yeah, it does.
Because somebody owes you.
Yeah, it works against you.
It works against you. So simple question. For a subscriber coming into our portal that goes to one of the accounting firms that is there as a core basket service, should that be something that they proactively take to that accounting firm and say, look, I need help addressing this issue?
Exactly.
And from a CFO's perspective, how would you guide them through that?
Well, I'm going to sound like a broken record. And I know it's boring, and I've been accused of being boring, so it wouldn't be the first time.
No.
Yeah, believe it or not.
CFOs aren't boring.
Anyway, the reality is this, man, it starts with planning. I don't care how good you are, how smart you are. You have to be prepared for the worst possible scenarios if you plan to have a successful business, and it's planning. I would tell anyone, we have to determine what are our short-term sources of financing, okay? That may be accounts receivable factoring. That might be a bank line of credit. If it's friends or family, that's good. But that question has to be answered. I would tell every business owner, if you have not found that answer, you probably should get it today or tomorrow, especially if you plan on scaling up.
And to that end, you can definitely find that and many other answers through the resources that we have at www.playbookinvestorsnetwork.com. And of course, we use this platform at Penn Global News every Thursday at 10 a.m. on Facebook and YouTube to speak to the important topics that affect small business. Rick, great point. Now we get to the owner equity.
Okay.
Because this is where all the ambitions come to the fore. We've run a good business. We've financed it through debt and other means. We've accounted for this lovely desk and chair and staff. We've got a better handle on our accounting. That owner equity has some aspect of debt associated with it. Has to.
Sure.
Unless you're the sole holder of the business.
That's
so
right.
speak to the importance of the owner equity and the owners being willing to perhaps give up some of that equity in soliciting the investing public for the capital raise.
All right, so
2 or 3 minutes.
very quickly, succinctly, owner's equity essentially boils down to assets minus liabilities.
Okay.
That rolls into, then we have two components. We have retained earnings and current year's profit or loss.
Okay.
That's our owner's equity.
Okay.
Okay.
Wow.
That essentially indicates the worth of the business at that point in time.
At that point in time.
At that point in time.
Because all this is a financial snapshot.
It's a snapshot. Balance sheet is a snapshot in time, generally at the end of the month, quarter, or year.
Or year.
Right.
Got it. And when we think about the income statement, because you and I both had those investors that we've talked to that want to follow every dime, every quarter,
Sure,
and trace it from top line to net income to statement of cash flow to this wonderful little entry that I love to talk about called retained earnings.
Right.
And there have been times where retained earnings didn't necessarily equal net income for the ending period of the income
without
statement.
a doubt, right.
It just sometimes it won't.
It won't.
But how important is it for retained earnings to be reflected in the balance sheet from an investor standpoint? How important is that?
Well, I think it's very important. Your investor or potential investors are going to use this either for you or against you. It's a measurement, again, on the effectiveness of management, how you use the resources that have been provided to the business. And it gives them an idea at a snapshot in time, a point in time, of how well you've operated or run this corporation. It's extremely important. Okay.
Yeah, because I think, and again, this is where, Rodney would always say, let's be devil's advocate. If we step outside of ourselves
Sure.
and look at this objectively, why would we not want to be able to follow, with a reasonable degree of accuracy, the flow of funds?
Sure.
Because I think the most important thing that we always look to impart on subscribers coming to the portal is understand the investing public is not looking to fund your BMW payment.
That is correct. Right.
They are investing in you because you've done a compelling job of presenting an idea
Sure.
that has some real traction in the marketplace.
Sure.
And for that investment in a belief, there's a expected rate of return.
That's correct.
So I want to be sure that there's something left in the till.
That's correct.
To meet my rate of return expectations.
Exactly.
So that's why I want to make sure we got that out there. Jesse McRae, COO and Managing Partner of Playbook Investors Network. Again, you can always find us in the portal, webinars, and other resources at www.playbookinvestorsnetwork.com. Penn Global News, as always, every Thursday at 10 a.m. Central. This was part 2 of the CFO series, the importance of the income statement. The statement of cash flows and the balance sheet with Rick Toussaint. Rick, one of the more humorous times that we've had in recent weeks has been understanding our process.
Right.
In terms of how these suppliers are coming to us, what they're doing inside the portal.
That's correct.
And how we're positioning them to go to the investing public. And I know that you've spent an extensive amount of time understanding our process. If there were 2 or 3 things that you'd want to convey to our subscribers as it relates to what they can expect being with the initial interface with the principles of Playbook Investors Network, including yourself, what would you sort of guide them to prepare themselves for?
I would imagine, or I believe they should expect a environment that champions success, an environment that believes that your success is going to be the success of the organization,
no question.
And back and forward. We want to see success stories, and there's a sharing of knowledge that we look forward to imparting upon potential subscribers and participants in the portal. I think it's an environment of cheerleading, but honesty and hard truths will be discussed and spoken. And I think that's in the best interest of the participants.
All parties.
Sure. Of all parties.
Absolutely.
Right.
Yeah.
I think the participants will see an investment community that is aggressively looking for new markets and new opportunities if you meet certain criteria and hit certain milestones. as an organization. And I believe it'll be our job to help bring the companies along and provide the resources to get there. Get there, certainly.
Yeah, great point. And selfishly speaking, having been involved in this process for quite some time now, I echo your sentiments. And we always like to make sure that our subscribers understand that the whole point in the spirit of what our CEO and founder Rodney Woods has always said is it's time out for apathy.
Right.
It's time out for that. This is not a venue for hymns. This is not a venue to necessarily reflect our passions by way of complaining and being complacent. This is a time for a tangible movement. The Playbook Investors Network was built upon a singular theme to change the game.
That's correct.
And of course, with yourself, our partners, Tracy McGrady and Antonio Davis, Doc Patton, Damon Williams, the immeasurable support of Chiquita Tate, our Chief Marketing Officer, our Chief of Staff, so aptly dubbed. Southern Girl, and of course, LaRonda Heitch, who's just the glue of the firm, and many others that you'll find on our website that support a very singular goal, and that is to make sure that we do our part to provide a venue to help you change the game. You're an entrepreneur. You had an epiphany. You had an idea, and you went through the process of helping that idea evolve. And now you just need a little bit of help, as we all do. Penn Global News is just another extension of what we call that help, being the Playbook Investors Network. You'll always be able to find us, www.playbookinvestors.network.com. Penn Global News every Thursday from 10 a.m. Hopefully you've enjoyed the part 2 of the CFO series with Rick Toussaint, talking about the importance of the income statement, the statement of cash flows, and the balance sheet and the capital raising process. Rick, can't thank you enough, man. This has been good.
Thank you.
I believe that we will, in doing our part, all of us will be rewarded for our efforts. And when we talk about rewards, we're not necessarily talking about monetary.
Right.
What we're talking about is doing our part as a part of a larger community.
That's correct.
Our community.
That's correct.
And so, again, I want to thank you for being a part of the team, helping us get this broadcast where it needed to be in a way that needed to be delivered.
Thank you.
And that was world class. Miss Tate, Miss Heitch, tell you 2 thumbs up. Couldn't have done it without you. And when we see you, if nothing else, we'll definitely get you some Christmas cookies. Right. But all humor aside, hope this has been a good show for you. As we always say in leaving, continue to make it a profitable week and be well. Jesse McRae.